Welcome to an introduction to accounting, brought to you by Parkbench Tutors. In this short podcast, we are going to look at a series of transactions when a business is started, and we're going to see how these would be reflected in a balance sheet. In an earlier podcast, you will remember we used the same transactions to show how the accounting equation was always balanced. And in another podcast we showed how the accounting equation was in fact reflected in the balance sheet. Now remember, we use the term statement of financial position, so we're stating someone's financial position at the end of these, 5 transactions. So let's have a look at them then. Catherine invests 2,000 of her savings to start her hair salon business. Right. So she has cash. So here we're going to put in the £2,000, which is her cash, and she then has the equivalent of £2,000 in equity, except that in this case they are referred to as capital or owner's capital, they're not shares. Catherine now takes out a bank loan of £1,500 towards purchase of equipment. Okay, so she's now got £1,500 more, so her cash has gone up from 2,000 to 3,500, but she now has a liability. For the sake of making it easy, I'm just going to call this a long-term liability. Catherine now purchased equipment for the business at a cost of £2,500, paying by cheque. So she now has some equipment. So here we are, we're going to put the cost of that plant and equipment in at 2,500, and if she paid for it by cheque, I now have to take 2,500 out of the cash. So my cash did have 3,500, so I'm going to be left with 1,000. And now she purchased an additional piece of equipment on credit for 500. Okay, so she now has £3,000 worth of equipment, but she has a creditor of 500. And now Catherine visits clients at home, uses her own car valued at 5,000 for the business. So she has a motor vehicle which is valued at 5,000, and she's contributed another 5,000 towards capital, which then becomes 7,000. So there are no retained earnings at this point, so her total for equity is 7,000. And let's just go through this. There is no depreciation, so her plant and equipment at this point is worth 3,000, and motor vehicles are worth 5,000, giving us a total of 8,000. So that's her net current assets. Her cash, she still has 1,000. She has no other sources of cash there, so that comes to 1,000. But she has here, let's have a look, current liabilities are 500. So her net current assets are, in fact, let's have a look here, £1,000 for current assets minus 500 there, so she has £500 basically as net current assets. So what we now want to do is take these two, add up the non-current assets and the current assets, which is 8,500, take away the 1,500 for the liabilities that we've got here, long-term liabilities. So 8,500 minus 1,500 is 7,000. So what have we got here at the end? Well, we can see that the assets less the liabilities comes to 7,000, which is equal to the equity. We have balanced our accounting equation, except that we've shown it in a different way. We've shown that on a particular date, the statement of financial position for Catherine following 5 transactions is assets minus liabilities equals equity. Thank you.